The Income Tax Bill 2025 is set to bring one of the most significant changes in India's tax laws, replacing the decades-old Income Tax Act, 1961. While the fundamental principles of taxation remain unchanged, this new bill introduces a modernized structure, simplified definitions, digital compliance mechanisms, and a stronger emphasis on automation and transparency. Today, we will break down the key differences between the old law and the new bill in an engaging and easy-to-understand manner. One of the most notable changes is the introduction of the tax year concept. Under the Income Tax Act, 1961, tax computations were based on the previous year and assessment year, which often confused taxpayers. The new Income Tax Bill 2025 simplifies this by aligning everything under a single tax year, making it easier to understand tax filing deadlines and payment obligations. The definitions of taxable income have also been expanded. The 1961 Act did not explicitly define virtual digital assets, VDAs, electronic transactions, and modern economic activities, leading to tax ambiguities. The Income Tax Bill 2025 consolidates all definitions and introduces clear classifications for virtual digital assets, digital earnings, and electronic transactions, ensuring better clarity for businesses and investors in the digital economy. Another significant change is in residency criteria. The Income Tax Act, 1961 defined residency based on a person's physical stay in India, for example, 182 days in a financial year. The new Income Tax Bill 2025 retains similar criteria but introduces detailed provisions for complex cases, such as individuals holding multiple citizenships or those with foreign income sources, providing more transparency for non-resident taxpayers. The heads of income remain largely the same, including salaries, house property, business and profession, capital gains, and other sources. However, the new bill expands these categories to include digital assets, online earnings, and technology-driven income sources, making taxation more inclusive for the modern economy. Deductions and exemptions have been restructured for better clarity. While the 1961 Act had deductions spread across multiple sections, the Income Tax Bill 2025 consolidates them under one structured framework. It also introduces special deductions for startups, digital businesses, and renewable energy investments, encouraging innovation and sustainability. In terms of capital gains taxation, the classification into long-term and short-term gains remains unchanged, but the new bill explicitly includes rules for digital assets and updates the tax treatment for certain asset classes. This move brings greater clarity for investors, particularly those engaged in stock trading, real estate, and cryptocurrency transactions. A major administrative shift comes in the form of faceless assessments and e-filing mandates. The Income Tax Bill 2025 places strong emphasis on automation and digital compliance, reducing human intervention and making tax assessments more transparent. The bill also enhances general anti-avoidance rules, GAR, ensuring stricter checks against tax evasion and impermissible transactions. For non-profit organizations, the Income Tax Bill 2025 introduces a more detailed framework defining taxable income, compliance requirements, and restrictions on commercial activities. This brings better accountability for charitable institutions and ensures that tax benefits are only availed by organizations genuinely engaged in social welfare. The bill also streamlines income from salaries, maintaining key provisions from the 1961 Act but increasing the standard deduction to 75,000 rupees, providing additional relief to salaried employees. It also modernizes perquisite taxation, explicitly excluding digital work tools and technology provided by employers from taxable benefits, aligning with today's remote work culture. A major shift comes in the treatment of digital assets. Under the Income Tax Act, 1961, there was no explicit taxation framework for cryptocurrencies and NFTs. The Income Tax Bill 2025 brings virtual digital assets, VDAs, under a structured tax regime, imposing a flat 30% tax on crypto earnings, with no deductions except for the cost of acquisition. Additionally, a 1% TDS remains applicable on crypto transactions to improve tax tracking. Another significant update is in tax enforcement. The new bill expands the definition of undisclosed income to include unreported virtual digital assets, meaning any undeclared cryptocurrencies or NFTs found during tax searches will now be classified as black money, just like undeclared cash, bullion, or jewelry. This ensures greater compliance in the digital economy and discourages tax evasion. In tax administration, the Central Board of Direct Taxes, CBDT, has been given greater powers to introduce compliance frameworks, digital tax monitoring, and enforcement measures without requiring parliamentary approval. This will allow tax policies to be updated more efficiently without bureaucratic delays. The Income Tax Bill 2025 is expected to become effective from April 1, 2026, giving taxpayers time to adjust to the new regulations. While the core tax structure remains intact, modernization, automation, and digital compliance are the central themes of this new bill. It simplifies tax filing, integrates AI-driven monitoring, and introduces clearer provisions for businesses, salaried employees, and investors. As India moves towards a more technology-driven tax regime, understanding these changes is essential for everyone, from salaried individuals and small business owners to investors and corporate entities. What do you think about these changes? Do you believe the new tax law will make compliance easier, or do you see new challenges? Let us know in the comments below. If you found this video informative, don't forget to like, share, and subscribe for more updates on taxation and finance. See you in the next video.